Strategic Trader Session 7, welcome back. We're going to go into something super important today, and it's going to be all around defining what our setups are. So to me, everything we've done up until this point has been really building a foundation, right? We built our house on a rock, not on sand. And it's been understanding what is a market, what is long and what is short, what are candlesticks, how do we read charts. That's really all we've done in order to really build the foundation to get to this point. And in this point, we're going to talk about what our main setups are. Now, what we're doing is we're starting with the end in mind. And the end in mind is understanding that we have two basic setups. In this session, we're not going to dive into the rules of each setup, and we're not going to talk about how we do each setup. This is really just describing what they are and why they exist. Because as we dive in to session number 7, what we're really focused on is understanding breakouts and reversals. And so the first thing that I'll tell you about breakouts and reversals, which a lot of people don't really grasp this concept, but they're essentially the same trade. There's really not much different between a breakout and a reversal because it's all about understanding the dynamics of order inventory that's added and left behind when price moves away from a particular area. And so that's really what we're going to talk about is the understanding the dynamics of order inventory. I've run into traders that are just breakout traders. They only will trade breakouts. That's all they do. They only trade breakouts. I've run into traders that will only trade reversals. They only want to look to buy when prices are dropping, or they only want to look to sell when prices are rising. And so the answer I give people is that both are good and neither should be exclusive, right? Both are good and can be good when following the rules, and neither needs to be the exclusive way that you trade. It's like saying we play the game of football, but we only run. Well, that's not very helpful. You've got to throw the ball every now and again. You got to pass. Or you say, well, we play American football, but we only pass. Well, you have to run the ball too. There's got to be some bit of balance. And so what we're going to look at ultimately when I'm looking at breakouts and reversals is what are the similarities between these two setups and where is their overlap, right? Because the two basic setups that we look for at traders are breakouts and reversals. And let's start with the definitions. Let's first start with the breakouts. So what is a breakout? At its core, a breakout is simply the area where there's a consolidation of price resulting in an imbalance being formed. And when we talk about a consolidation of price, what we mean is that prices hit a particular area and they continue to then move inside of that area, right? So let's take a look at this particular picture that we have here. This is an example of what a consolidation might look like. You have one area where prices continue to kind of come up and hit their head, and prices are going up and coming back down and going up and coming back down and going up and coming back down. But if you notice, that's a consolidation around a particular price point. Eventually, once we run out of one type of orders, prices are going to thrust through. Now, in this case, it would be a breakout to the upside. The same picture exists on a breakout to the downside. We just take the same picture and we make it a reversal of the other. But remember this about buy orders and sell orders. When I'm looking at a breakout, we always go back to those orders that we talked about earlier in our sessions. We talked about how the market is made up of unfilled orders. And when thinking about this as a particular strategy, the thing that I always come back to is whenever price comes up to this level, in order for price to be here, I have to have buyers and I have to have sellers. They both must exist in order for price to trade up here. Now, since price moved away, we know that at that point, sellers were greater than the number of buyers, right? We know at this point here, sellers had to be greater than the number of buyers in order for price to drop. Matter of fact, we know we can go so far as to say that at this point here, let me erase these. We can go so far as to say that at this point right here, right there where price moved out of that level, that there were no willing buyers at that price. There were no willing buyers there, but there were still had to be willing sellers. Sellers greater than 0, buyers had to be equal to 0, and that's what caused price to fall. Now, what did that do? Well, if we think about it in terms of these, we talk about these stacks of orders. When price came up into that level, it used some of that order stack. And so that order stack got a little smaller. And every single time that we come back into this area, we're going to see that the sellers outnumber the buyers. The sellers outnumber the buyers. The sellers outnumber the buyers. And it just continues to happen, right? But notice the first time we got a move out that was this far. The second time our move out was only this far. The third time it was a bit less. The fourth time it was a bit less. So what we're seeing here, and this is really where we'll talk later about what are called price patterns, but this would be considered an ascending triangle pattern. What we're seeing is that sell order inventory is being depleted. And eventually, once there are no more willing sellers, we know that buy orders have to still remain in order for price to rally up. So at this point where our line is drawn, we see that buy orders remain, yet sell orders are depleted to 0, and that's what causes a breakout. The breakout exists because I run out of willing sellers, but there are still willing buyers. So when we think of it in those terms, the breakout is nothing more than buyers controlling the direction because there are no more willing sellers. So here's an example on a chart. So on this particular chart, we see an area where price is consolidating after a strong rally. So we know that at this point in time, there was a fair amount of buyers that drove the stock price up. Matter of fact, drove it up from 17 all the way up to 51. And at 51, it started to stall. A little bit of a pullback, another bit of a pullback, and then in here it started just kind of consolidating. Well, that would tell me, all right, well, when we get above there, there might be an opportunity to buy. And that particular stock did give us a good breakout area to buy and then moving higher. But what it was that allowed us to see the orders, kind of consolidating was the fact that we hit here and came down, hit here again and came down, and then hit here again. And it was that multiple areas you can see, and that's what led to price moving. And in this case, it was a movement of almost a 50% move in the stock up to that level, right? And it was after the breakout, it was a really, really strong breakout move in that position. So this is what's called a breakout, right? On a breakout position, that's commonly what you'll see. Well, what about a breakdown? And a breakdown works very much the same way. Somewhere down in this area where our red is, we can see that right here we had buy orders in place. And the buy orders drove it back up. And here the buy orders hit again and drove it back up. The buy orders hit again and drove it back up. But each time we come into this zone, what are we doing to our stack of buy orders? Well, what we're doing essentially is, if you think about it, we're just taking a little bit more off the pile each time we come into that level. Until eventually, if there's nothing left of the pile, and the pile's now all gone, our buy orders equals 0, and there are still willing sellers. That's what causes price to break out to the downside. Now, you'll hear this referred to as a breakdown, right? There's breakouts and breakdowns. And a breakout is typically going to be up. A breakdown is typically going to be down. You may hear somebody just saying we broke out to the downside. That's okay too. A bearish breakout is fine. But essentially we break out when we're going up and we break down when we're going down. But what causes the breakdown is the lack of willing buyers at a given point, right? Remember, it's the lack of willing buyers and the lack of willing sellers that truly cause price movement. So here's an example. We see an area in a stock that has been hit on a number of occasions, right? Touched it here, touched it here, touched it here. And each time we've touched it, we've gotten a rally out of it. We came pretty close to it here. and got another rally out. But now we've come back to it, got a little bit of less rally, and now we're kind of hammering sideways in front of it, right? So this is a very, very common setup where we see that prices really tried to rally back up. Now, an interesting thing on this one is that we do see that prices had tried to rally back up and were unable to get to some of these other areas that were highs. And then every other time that we came back up, we were really unable to break out these new highs. And by being unable to break out these new highs, that told me that, yes, there were buy orders in here, but there weren't enough buy orders in here to have confidence or to have enough fortitude to drive it through some of those swing highs. And the breakout setup took that thing from 83 all the way down to $16 a share. It was a huge breakout trade as price came hammering down from that particular level. So when we think about a breakout or a breakdown, they are nothing more than orders and running out of orders, right? When price breaks out to the upside, we run out of willing sellers. When price breaks down to the downside, we run out of willing buyers, and that's what causes prices to move in a breakout. Well, how's that different from a reversal, right? Well, it's really not. It's all about identifying order flow. So reversal trades exist when there's an imbalance of orders at an area where the number of buyers and sellers causes price in the short-term time frame to change direction. So when I'm looking at a reversal might look something more like this. We have price that is going in one direction, right? Maybe price is going down. What is going to cause it to reverse direction and then head back up? Well, the only thing that causes price to reverse direction and head back up is running into an area where there are no more willing sellers, but there are still willing buyers. So this is called a reversal trade. Reversal trades are trades where we change the short-term direction of the security. It was going down, you buy and it goes back up. Now, this is directly in the face of what a lot of people have been trained and conditioned to do all of our lives. A lot of people have been trading all of our lives to only buy stocks that are in good areas, right? Only buy stocks that are going up. And while I do agree with that, typically when I'm talking about trend trading, on the smaller time frames, I'm oftentimes going to have to be looking into reversal trades as a way to get into the bigger picture move. And so we'll talk about what we call trade magnification levels in another session. But when I'm looking at buying, means I'm buying as price is dropping. What about if we are selling when prices are rising, right? We would sell when prices are rising in the case of a reversal to the downside. So reversal trades are simply getting in at the turn in price. It's been said that the highest probability entries are going to be at or near the turn in price. And while I agree that we want to buy at or near the turn in price, it's going to be finding the right turns in price, right? We want to buy at the low and sell at the high, and that's really what the reversals are designed to do. So when we look at something like this, taking a look at a reversal, right up in this area over here, when I'm looking at this area here, we know that while we were in there, buyers equal sellers. We know that, right? Because price was in there and it stayed for a certain period of time. We also know that at this point right here, at that exact moment, buyers equal 0 and sellers were greater than 0. Now, how do I know that? I know that because there were no more willing buyers. If there was, price never would have fallen out of that level, right? Think about it. If you're a seller, do you want to sell down here? No, you want to sell up here. But there were no more willing buyers. So buyers equals 0 at that point. It's that imbalance that caused price to movement. Now, this is going to be the origin. We call this the origin of the move. This is the origin of the move. And we're very rarely we're not really gonna predict the origin of the move very often. But what the origin of the move does is it leaves clues, right? It leaves clues behind. And the clues that it leaves behind are what happened as price left away from that area. Well, we know that price moved away from there very quickly. So the question is, did every single seller who wanted to sell up at this price get their order filled? The answer to that is no. We know for certain that they didn't get their orders filled or price wouldn't have moved. So there's still going to be a stack of willing sell orders that are remained over here, right? So there's still going to be a stack of willing sell orders that do remain. Now, at some point, you're probably going to have more buyers that come into play. So you'll also have, at this point, a stack of willing buy orders, right? So I've got at this price level, I've got a stack of willing sell orders and a stack of willing buy orders. Well, if those sellers and those buyers transact with each other when on the return, so price returns, and for every buyer there's a seller. For every buyer there's a seller. Oops, it keeps popping that menu up. Stop it. If in here for every buyer there's a seller, eventually I won't have those sellers, I won't have those buyers, but I'm still going to have a stack of willing sell orders remaining. And that's enough to cause price to come in. So the entry is right when price retests the origin of the move as a potential short opportunity in this case, right? So that would make this a potential short opportunity in this case. Because right here, there was a certain number of buy orders, but those buy orders were reduced. They were reduced again, and the sell orders remain. There are no more willing buyers, so price falls. So here's an example of a long position, right? So if I look at this ADP trade, we can see in this ADP trade, we've got a little bit of sideways price action at the origin of the move, all right? So if we think about simply the origin of the move is this area right here, which caused price to rally straight up out of that level. That was the origin of the move. Now, we know that at that level, buyers and sellers were at a state of equilibrium. So if buyers and sellers were equal at that level, during that period, price moved away, I still had buyers remaining. Now, price returns into this level and your buy orders continue to grow. There are more buy orders added to the queue, and there's buy orders that are remaining. So you have an opportunity to buy at that level. Now, what's interesting is that we spent a little bit more time around there, so maybe more buy orders were put in. And the second time we came in, it worked again. And the third time we came in, it worked again. Now, something interesting about noticing how well it worked. Looking at this particular example, if I kind of zoom in on this one, notice the first time that we traded into this area, we only traded this deep into the level, right? Very, very shallow entry into the level right here. The second time, we made it a little lower. The third time, it made it all the way nearly to the bottom. So that tells me that each time we come in, we're trading a little bit deeper. And by trading a little bit deeper, every time we come in, we are showing that the number of buyers are being depleted. Okay? And that's the picture that we're looking at here, right? Buy orders and sell orders are unbalanced at turns in price. Buy orders remain, but sell orders are depleted to zero, and that's what causes prices to rally. Let's look at a short example. So in a short example, we have this area, which over here on the left, which is the origin of the move, right? So upon the origin of the move, we see that buyers and sellers had to be at a state of equilibrium. Price moved away. When price moves away, I know that my buyers equal zero. My sellers had to be greater than zero at that exact point. When we return, we trade into the existing buy orders, sell orders, and there are some buy orders there, but those are all eliminated. We know that they're eliminated because price moves away. Notice the first time we only came in this way. The second time we came in all the way here and price moved much stronger. Now, think about this for a moment. The first time we traded all the way to here, the second time we traded all the way to here. How many sell orders do we think are going to be remaining from that origin? My guess is probably none, right? If there is some, it's probably a pretty small amount. But when I look at those reversal areas, the reversal areas that exist here and here are not necessarily going to be something that I would use again, but they certainly are good to be used the first time through. So when we're looking at our breakouts and reversals, the thing to remember is that they are essentially the same trade. It's all about order flow and order inventory. So as we move into our next session, we're going to start to build to build the plan around what are the rules that we use to set these trades up. So as always, if you have any questions, send us an email, support@tradersarmy.com, or shoot us a text. See you in the next session.